the right stock at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Mayuresh and you're watching Indian Open. Let's go straight to the headlines. The Indian currency ends at a new low of 71.21 to the dollar. A 10-year bond yield spikes close to 7.99. Crude prices inch towards a 2-month high as sanctions on Iran impact sentiment. SEBI dismisses questions raised over its jurisdiction to probe alleged mis-selling by 5 brokerage firms in the NSCL scam. The Reserve Bank of India directs all scheduled banks with more than 10 branches to set up an internal ombudsman. Well, let's take a look at the trade setup for the day first before we tell you what's lined up on First Word. The Nifty yesterday, when we were talking to analysts, they pointed out how we've broken some key channels on the daily moving averages. If you just plot the channel lines on the Nifty movement for the last 6 months, yesterday's fall on the daily channel led to some bit of downtick. And let's see if it puts further pressures on the markets. The calls that were given out yesterday across from market men seem to suggest that there's a bit of pressure that could last for the Indian bourses over the course of the next few days as well. Multiple reasons really about them. The oil uptake is likely to keep the pressure on the Indian markets because Brent oil reached almost a 2-month high of $78 to a barrel. And remember, there's a direct negative correlation. Crude prices move up, we tend to be under pressure, and it's no different right now. The oil uptake may put pressure on the Indian markets, in all probability will, and the $78 to a barrel is not a level that people like. I mean, we were almost getting used to a level consistently staying sub 75, sub 74, sub 73. Now, a level of about 78 to a barrel may not stick out too well. The signs of some bit of risk averseness was evident in the precious metal space as well. Gold intermittently touched levels of close to $1,200 per troy ounce as too. So something you need to watch out for. And it was all evident in the money markets. Multiple reasons by them. We'll talk about them throughout the course of the day. But multiple reasons. One, the rupee continued to go off 71.21 versus 70.99 as close on Friday. So these are new lows that we have for the currency. The 10-year bond yields are almost back to that 8% mark as well. And that doesn't augur too well too. So the money markets are looking slightly wobbly. There are multiple reasons for this, by the way. The market is rife with the talks of how the non-resident investors or non-resident and institutional investors being forced to wind up their select positions on the basis of the SEBI directive is probably the one reason why there was pressure on the money markets in the session yesterday. And we'll talk about that a bit later on in the show. But multiple reasons for what the currency did. Maybe crude had a part to play there as well. And we'll talk to Jayesh Mehta about this a bit later on in the show. However, what are the stocks that you should be watching out for in the session today? Needless to say, the oil marketing companies right up there. Be it the crude uptick, be it the currency weakness, all of this puts pressure. Let's wait and watch if there is some further pressure on BP, HP, IOC in the session today. These would be close to maybe 1-month lows or thereabouts for these stocks. Let's wait and watch what happens here. IIFL Limited, I thought, was an interesting one. Ashish Kacholia has acquired about 20 lakh shares, 1.62% at about 166. The stock was very active yesterday. Now you know the reason. 10 million shares traded yesterday, but that notwithstanding, let's wait and watch if there's some further activity in IIFL in the session today. And HSBC's come out of the report on Quest Corp. They have maintained a buy with a target price of 1,400, a potential upside of 43%. HSBC believes the company is confident of growing at 20% organically and meeting the 8% margin target in the medium term. 8% for this business is very, very strong. And HSBC believes that this company could do that, and that could only augur well in the medium term. So do watch out. It's a stiff target price as well. 1,400 is fairly steep compared to the current market price. Okay, so lots of individual names, but I would presume while the SGX Nifty is not showing that, and remember the US markets were shut in yesterday's session on account of the extended weekend because of the Labor Day holidays. The cues from around the world very flat. Asian markets are flat, marginal downsides, but you would call this flat. The SGX Nifty too, hardly any movement. But yesterday's downtick, what it does is put a little bit of a pressure or put a little bit of a lid on the upsides on the trading minds. And let's see if that has an impact on our markets today. We'll talk about all of this a bit later on. But first, tell you what's lined up on First Word today. A collection of the top editorial stories that we believe we should bring to you. Naveen Jindal is willing to pay heed to the suggestion of splitting his businesses and 3 different verticals. So what will each division house? Darshan does that analysis for us. 2 big ticket deals later, Anil Ambani may finally manage to get some grip over its group's bulging debt problem. Somit tells us how. FMCG companies have been the flavor of the season, but where does this leave the valuations? Jayesh and Agam join in on that. And the 3 recent listings have not really had a great time on the bourses in the NBFC space, housing finance space as well. Shraddha Babla joins in to tell us why. Well, so 4 important stock-specific stories. Let's discuss all of those. Firstly, JSPL. Considering a business restructuring as part of its plan to trim down its 42,000 crore debt pile, the company looks to break up its steel, power and international businesses. Darshan Mehta joins us with the proposed structure and the possible value creation. Darshan, good morning.
Yeah, so Neeraj, on Bloomberg yesterday, the interview, Naveen Jindal told that, in terms of cutting debt, they have a massive debt of 43,000 crores. They're looking to do a little bit of restructuring, which would probably mean, splitting the company into 3 parts. So let's take a look at what exactly the current structure of the businesses. So basically, the steel business is there. They have steel, they have iron ore, and they have pellet. The power business basically is 2,400 megawatts. They have 3,400, but 1,000 megawatts is already divested, which will happen very, very soon. So currently with them, independent power and captive power is 1,634. And as far as the international business is concerned, they have an Oman steel plant and they have coal mines in Australia, South America, and Mozambique. So this is the current structure as far as their business is concerned. Now, what are they proposing to do? Now, what will happen is that the international business, the only change that will happen is that the international business will only be the Oman plant, from which the coal mines will be shifted into the steel plant. So that's the restructuring he's talking about, and these 3 will be separately demerged and probably listed at a future time. What also they are looking at is that, for the international business, they're looking at for an IPO at a later stage. So this is the proposal that Naveen Jindal had indicated. They're also looking to sell some of the coal mines if they get a buyer. So that's the broad restructuring that they've planned as far as the business is concerned. Now let's take a look at what exactly is happening. Proposed restructuring, demerge steel, power and international businesses. So the international business, so right now as far as the financial is concerned, Oman steel numbers are consolidated with the steel numbers. They have power numbers and they have other, which is the coal mine number. So they want to get everything separate. So steel, power and international business will be separate. To consider an IPO of Oman steel plant in the next 2 to 3 years, we'll discuss more about this in detail, what this plant does. And Australia coal mines may also be on the block. This is the other business that they have, which they're planning to merge into the steel business. So this is the proposal of restructuring, as Naveen Jindal told Bloomberg yesterday in news. Now, what exactly are the financials, what we've seen? Over the last 5 quarters, what we've seen is that, after almost 14 quarters, JSPL in the first quarter managed to come out with a profit this time around. Even if you see that the revenues are continuously increasing, the company has been reporting a lot of losses except for the first quarter. Now the reason here is that the revenues have grown up significantly, but their interest cost is so high that, and earlier also steel prices were not high, that they were actually facing a lot of issues. Now if you're looking at what's happening from FY13, when their EBITDA was almost 6,000 crores, their debt was almost 570 crores. Now their debt has gone up significantly, while in the middle term what we saw was that the EBITDA stayed at the same level, and they had to take a lot of debt because of issues that they faced, because when their coal block allocation happened and the Supreme Court cancelled that, they had to take a lot of debt to actually go ahead and complete some of their projects. So that's why debt skyrocketed for JSPL. So that's the broad maths that we're looking at as far as JSPL is concerned. What is the debt reduction plan? He's talking about cutting debt by 15% this fiscal. They won't take any more debt. The debt equity ratio they're targeting of 2 times in the next 4 years, from close to 5 now. Remember, last time this number was almost 8 times. So they managed to cut it already by 50% as of now. So this is basically the broad-based plan as far as debt is concerned. Why the demerger? Debt reduction is the main thing. They have a 42,000 crore debt on the book. Value creation for shareholders, IPO of the Oman business, and slower ramp up at the Angul plant, which is clearly not happening. They've cut the guidance for their steel at Angul. So they want to actually restructure their business, so every business actually becomes much more profitable for them.
Okay. Darshan, so you spoke about all of these businesses. Can we look at them individually, especially the Oman plant?
Yeah, so basically let's take a look at the EBITDA contribution and what each of them gets on the table for JSPL. Basically, if you're looking at the composition, 72% of the EBITDA still comes in from the steel business. Oman gets in 20%, the power gets in 4%, and the others, which is basically the coal mining, gets in a negative 6%. The growth has been very strong both for the steel and Oman business. On a year-on-year, they grew almost more than 100%. Power actually saw a decline of almost 33%. So clear growth is seen on the steel business of JSPL. So that's the number that we're looking at. Now, if you're looking at the Oman business, it's called Jindal Shadid. It's a 100% subsidiary of JSPL, and 26% of the consolidated steel that JSPL produces comes in from the Oman plant. So that's the Oman plant for them. What is the business here? Capacity of 2 million tons per annum. They did a production of 1.67 million ton as far as FY18 was concerned. So there's still substantial upside that is there. They have a hot briquette iron capacity of 1.5 million tons per annum, and they have a rolling mill capacity of 1.4 million ton per annum. So this is basically what they have as far as their entire Oman plant is concerned. The other factors that we want to watch about is the performance of the Oman plant. Sales volume has increased significantly from 0.34, it's moved to almost 0.42. Last quarter was a little subdued, but their EBITDA per ton has gone up significantly. Their EBITDA is also rising. So if you're looking at the EBITDA per ton, from a 6,000 rupee, it's moved all the way up to almost 10,800. The EBITDA came off slightly lower because of lower sales volume in the first quarter, but no doubt their Oman subsidiary is doing well, and that is why probably they want an IPO going ahead. As far as the other factors are concerned, how would the target price breakup happen? What are people giving what? So the steel business, Morgan Stanley gives a valuation of almost 52 rupees, IDFC at 260. Kotak is rather negative on JSPL. As far as the power business, anywhere between 80 to 100, and the international business, there's a negative value both by Morgan Stanley and Kotak Securities, given the fact that the coal business, coal mining business is not doing well for them. So basically the play is basically steel, where the highest value is there for JSPL. Basically, our analyst bullish. Yes, 14 out of the 17 analysts are bullish on JSPL. The potential upside that they speak about is almost 45% on JSPL from the current target price. So that's the analyst view that we is looking at. But nevertheless, there are two analysts which are still negative on JSPL. But that's the broad contours. They've announced it. This will take some time. But this is the rationale and what JSPL will look at if they go ahead with 3 separate divisions.
Well, interesting. Let's see how and when it happens. Darshan, thanks for putting that into perspective. If you're wondering as to how the different businesses of JSPL could look like whenever they do, well, this is a small glimpse of that. The next piece is about the Anil Ambani firms. That part of the Reliance group has been grappling with debt of more than 1 lakh crores for at least 4 years now, maybe longer. And with creditors lining up with a long list of outstanding dues, the group was left with no option but to sell some of its steels. 2 deals later, Anil Ambani may have finally managed to get some hold over the total outstanding and total interest payment. Somit Sarkar is here with the details. Forever a group that is clouded by one argument, Somit, that they are heavily indebted, they seem to be turning a few things around.
Well, yes, the debt reduction plan is finally working for Anil Ambani. One big deal, that is the Mumbai transmission deal, has been completed, while the other one, that is the sale of telecom assets, is on its way and will be completed very soon. Now, this massive debt reduction plan will bring down the total debt of Anil Ambani group companies by nearly 60%. Obviously, the interest burden will also come down. Now, if you see in financial year 2018, the total interest burden of Anil Ambani group companies was close to 10,000 crore rupees, while their total debt was more than 1,03,000 crore rupees. Now, post this stake sales and divestments, the total debt would come down to close to 49,000 crore rupees. That is a reduction of nearly 60%. Now, here Anil Ambani group companies means the ex-BFSI companies, that is Reliance Power, Reliance Naval, Reliance Communication and Reliance Infrastructure. Now, 2 deals that led to this reduction in debt. First was the Reliance Communication. Now, here they sold their Spectrum Tower and other assets to Reliance Jio for an estimated amount of close to 25,000 crore rupees. Now, we don't have the exact deal amount, but analysts are expecting this amount to be close to 25,000 crore rupees. Now, along with this sale, the company is also looking to sell its 125-acre land bank at Navi Mumbai. Now, the value of this land is expected to be around 10,000 crore rupees. There's no deals as such that has happened for this land bank, but the group is very confident that they'll sail through this land bank deal also. So altogether, our Reliance Communication is servicing a debt of close to 35,000 crore rupees. rupees. That is a major part of that debt. Now, the second deal was from Reliance Infrastructure, where it sold the Mumbai Power Transmission asset to the Adani Group for close to 18,800 crore rupees. Now, of this, 13,800 crore rupees will be a transfer of debt, while the remaining 5,000 crore rupees will be a cash inflow to Reliance Infrastructure. Now, post this deal, Reliance Infrastructure, which was once not able to service its debt, will become a debt-free company for the first time from financial year 2006. Now, last time in financial year 2006, the company was a debt-free company. Post that, the company was had a debt burden on its book, and now post this deal, it will become a debt-free company for the first time. So, what are the two possible concerns now for the Anil Ambani Group companies? One is Reliance Naval. Now, the debt on Reliance Naval is close to 5,300 crore rupees. The amount looks a very small amount, but it is nearly 4 times its market capitalization. Now, we don't have much detail on what the company is planning to do on this debt, but according to the company, they have been working with the lenders to get a resolution, and they're positive that they'll find a resolution for this debt very soon. And second one is Reliance Power. Now, if you see in Anil Ambani Group companies, Reliance Power is the only company which never had any debt issues like the other companies. But recently, it was downgraded by 1 notch by ICRA on the back of the high level of leverage that the book has, and because of refinancing risk that ICRA sees. Now, this company has been able to bring down its debt over the years. Now, if you see over FY15 to FY18, the company's debt has come down from 33,000 crore rupees to close to 28,000 crore rupees. But along with this, its ability to service its debt and interest burden has also come down. It has come down from 2.4 times. Its interest coverage ratio has come down from 2.4 times to close to 1.58 times. So there has been a reduction on this, and this could be the only concern now for the Anil Ambani Group companies, as the other two concerns are now going away.
Very interesting. Samit, is there a outline of what happens to these numbers over the course of the next couple of years? I mean, something that has anybody been able to stargaze?
No, for Reliance Naval, actually no one has been able to stargaze. The company has also not given any projections. They are saying that they are working with the lenders, and they are positive that it will come out with a resolution very soon. For Reliance Power, as such, they have been able to service that debt. They have been able to refinance that debt. So there have been no concerns, but it could be a concern because the ability to service that debt that has come down. So that could be a concern, but as such, as of now, there has been no concern on that.
I'm just thinking out loud. Really speaking, there are these 1 or 2 or 3 groups, as large groups, which have kind of shown the will and the gumption to
last time was the JP Group,
and now it's Anil Ambani Group. We hardly have groups per se which have managed
been able to reduce the debt and successfully.
Very interesting. Okay, Samit, thanks for putting this into perspective. Very interesting, and I'm sure you will get this story on the website as well. There will be an article around this, so do log into bloombergquint.com and try and get that piece as well. Okay, the next piece on First Word. 3 financial players that made their debut on the bourses this year are trading below their listing prices. High valuations commanded by the IPOs seem to be the common reason for their underperformance. Shraddha Babla is standing by with a closer look. Morning, Shraddha.
Morning, Neeraj. So, if you leave aside HDFC, AMC and Bandhan Bank, all the other BFSI companies which have made their stock market debut this year have actually given negative returns to investors. So, you look at ICICI Securities, it's down 36% from its issue price. Indostar Capital is down 19%, and Credit Access Grameen is down about 10% just in the last 2 weeks since listing. To some extent, you could argue that the subscription numbers said it all already, because if you look at the subscription numbers for ICICI Securities, it was subscribed just 0.78 times. Remember, it's the ICICI mutual fund schemes that had come to the rescue, even as the HNI and retail portions remained undersubscribed. In case of Indostar Capital, the total subscription was 6.8 times. Nevertheless, it was driven largely by the QIP portion, even as the retail portion was subscribed 1.5 times. In case of Credit Access Grameen, the total subscription was 2.22 times. Once again, it was the QIBs which had come to the rescue because the HNI and retail portion remained undersubscribed. Now, what went wrong, or what is plaguing these companies? First, if we talk about ICICI Securities, recently we have seen a slowing down as far as the broking revenues are concerned. There was a flat 1% year-on-year growth even in the latest quarter numbers that were reported, and this is important because broking is the core business segment for the company, we've seen a muted performance there despite ICICI Securities having the highest number of active clients. That apart, there is also all these regulatory and corporate governance linked issues. Remember, aside of the ICICI mutual fund schemes which came to the rescue of the IPO and the way it was pushed, you also recently had an advisory firm which had recommended not to vote for reappointing Chanda Kochar on board. You also have, more importantly, high valuation which could be weighing on the stock. The asking PE at the issue price for ICICI Securities was a 49.6 times its trailing earnings, a big premium compared to its other listed broking peers. Now, if you look at Indostar Capital, what the street probably doesn't like is its overall nature of the business, because it is mainly a corporate lender with a high real estate exposure. So corporate or wholesale lending forms 79% of its book, as compared to the retail segment or retail financing, which is finding favor with investors these days. And nevertheless, the NBFC is making efforts to diversify into new lines of businesses. They've introduced housing and vehicle financing loans. Nevertheless, what analysts believe is that there is a long road to diversification. While it will take time for the NBFC to diversify, especially in a hyper-competitive environment, they believe that it will remain predominantly a wholesale lending NBFC, at least for the next few quarters. That apart, you also have low ROEs which could be weighing on the sentiment. The ROE stood at just 10.7%. Even the ROAs were extremely high at 5.5% in FY13, but they have come down to just 3.8% as of December 17 and expected to fall further. When it comes to credit access, Grameen, the key factor is the key concentration risk. Just 2 states contribute about 86% of the company's AUM. That apart, there have also been questions which have been raised about the company's long-term competitive positioning. If they are unable to offer any loans beyond the plain vanilla JLG loans, especially given the changing microfinance landscape where peers like Bandhan and Bharat Financial are taking other retail products to the doorsteps of the rural consumers. So that's one thing where the issue lies, as also suboptimal ROEs were just at 11.8%, and this is pre-IPO dilution, so that was another concern. And finally, expensive valuations, because at the issue price the stock was available at a multiple of 2.9 times price to book on a post-issue basis, again at a premium to what Saturn Credit Care does. So overall valuation didn't seem justified, and that probably tells you that IPO pricing remains a key issue, especially for NBFCs which have seen significant correction since or in the interest rate rising scenario, Neeraj.
Yeah, well, quality at any price seems to be taking a bit of a backseat on the listed bourses and in the primary markets as well, or other companies that are getting listed. Shraddha, thanks for putting this into perspective. Very interesting how the recent performance of some of these highly decorated names in a highly decorated space have done. Could that be happening to consumer stocks as well? That's the question. Now remember, they've been in favor this year with almost all of the stocks posting double-digit gains, but that also triggered higher valuations. A two-part piece, which is the last piece on First Word today. First, Jayesh Khilnani standing by to put the numbers and the historical valuations into perspective. Jayesh, good morning.
Morning, Neeraj. Yesterday when I was working on this piece, little did I know that the FMCG index will actually end up as the worst performing index amongst all of them. And in fact, what happened with that is that from the record high valuation that we have, it dipped slightly, but the larger picture still remains. So what you have on the screen is 1 year forward PE chart for the Nifty FMCG index, which is represented by the white line. What you have in terms of the other colors is that the blue line is the average PE of the last 5 years, which stands close to just less than 30 times. And if we can have the 1 standard deviation plus 1 standard deviation, that stands just above 32, which is the yellow line, and the red line denotes the plus 2 standard deviations from where the average line is, which is close to 36 times. But where are we currently is more than 38 times if you have a look at the last piece, and we were almost inching up towards the 3 standard deviation mark, which was just close to the 40 level. So But with yesterday's price decline, we have in fact seen a dip in the valuation as well. But what the other interesting bit that stands out, Neeraj, from here is that only once in the past, in 2017, the valuation has gone above the 1 standard deviation or the 2 standard deviation mark. So, you know, this is something of an abnormal impact that we had seen as far as the valuation is concerned. Now, this of course reflects in terms of the individual stock valuation as well, if we can have a look at that. So these are all the 1-year forward estimate PEs that we have from the Bloomberg terminal. What is important to note over here is out of the 15 members that make up this index, 7 of them have valuation in excess of 50 times 1-year forward earnings. So, you know, nearly half of them at more than 50 times. And the lowest one, which is in the top 10, that is Imami, that also quotes at about 41.4 times, which in itself is more than the index that we saw, which was at about 38 times. So, you know, maybe a little too stretched, maybe a little too much on the higher side in terms of the, you know, individual stock valuation as well, Neeraj. So, you know, some numbers to give you perspective of how the 1-year forward of about 38 times comes about.
Yeah, I mean, I think the more interesting bit was the first chart, excuse me, which shows how significantly above premium valuations are we trading at. The 2 times standard deviation has been a barrier. We are comfortably above that. Let's see if we find our way back here. But so what are the most expensive stocks and what are analysts saying about this FMCG basket?
So, Neeraj, out of the 15 stocks, there are 4 such stocks which are, you know, trading more than 2 times their standard deviation as compared to their 10-year average. So, you have Dabur, which trades 3 times above the standard deviation. Godrej Consumer Products, 2.8 times above standard deviation. Britannia and HUL also 2.3 to 2.7. And remember that these are heavyweights. So, you know, these actually moved the index. Yesterday, we saw that the Nifty went down about 100 points, largely contributed by ITC and HUL. From the FMCG pack. And if you have a look at what the analysts are saying, you know, just going by the target price, there's not much room for upside when it comes to these FMCG stocks. So some of them have in fact negative potential, which means that either the stocks have run up too fast for themselves, or the analyst will in time revise their target prices upwards. But even if you have a look at where the return potential is positive, have a look at the numbers. So not much to go by, just about 1 to 2% upside that the analysts are expecting on some of these key counters. So, you know, overall, if you have a look at the target price, some of them are fairly priced, some of them may look overpriced as compared to, you know, when we compare it to the target price that the analysts have on the street.
Okay, Jesh, thanks for that. But, you know, the question is whether this rally is based on some solid fundamentals, Agam.
Right, so, you know, Neeraj, CLSA is just one of the latest brokerages to acknowledge that these valuations are very heady, they're very rich. But through the conversations with their clients, there is a suggestion that their clients are still looking to buy into FMCG stocks. And the reason is that FMCG stocks are best placed and they're preferred. They're no longer a hiding place when it comes to something like your cash generation, your balance sheet, your growth prospects. Let's not forget we're going into an election year, which means that there will be a lot of uncertainty, but FMCG and consumer staples in general is the only place that will have stability as we move in. We also have to remember that all these companies, they may be staple companies, but they've also made a very strong niche for themselves, and that's really working out for each and every one of these companies because the way they've positioned themselves in several of these product categories. And that's perhaps the advantage. Of course, let's not forget something like a GST, which plays out as well, and at the expense of the unorganized sector, and a lot of these companies have been gaining market share at the expense of that. So these are just some of those ideas and some of the reasons behind which we continue to see buying in FMCG companies. But that said, brokerages are still of the opinion that they are very richly valued.
Yeah, well, no surprise there. The question mark only is whether these valuations can last or whether there could be some course correction. Right. I mean, 2 standard deviation or thereabout. That will be a steep one. We haven't seen that in a while in the FMCG names. Agam, thanks for bringing us that update as well. So brokerages continue to remain bullish. Multiple triggers for these stocks as well. That, you know, trees don't grow to the sky. At some point of time, there'll be some gravity that they will have to face. Okay, that's all that we have on First Word today, though. Lots more lined up on IndianOpen. We discussed the pressure points in the cement industry with N Srinivasan of India Cements. But more importantly, After this quick break, we come back, talk about the pressure points for arguably the talking point of trade yesterday, which was the currency. We talk about 2 or 3 factors that could be responsible for the currency and the market pullback, and get in Jayesh Mehta to talk about his views. That's coming up in just moments from now. Stay tuned.
The heart wants what it wants, and mine has led me to some amazing highs and lows as I followed its guidance from software development to investment banking and then into my own startup. I'm Ahmed Aftab Naqvi, and my journey has been a roller coaster ride. When I started my company with a single laptop in a garage and 2 friends armed with just the burning desire to create something, I had no idea that we would create a whole new paradigm of marketing. Today, Gozoop is at the forefront of the industry, a thought leader in the space, and voted as one of the best places to work for in India. But we didn't get there quickly. But everything taught me and engineered our success. It's an interesting story, and I'm really looking forward to sharing it with you.
Aegon's of business never stop. Only on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome back. You're watching Indian Open right here on Bloomberg Quint. A quick snapshot of what we're doing in terms of the Asian market setup. Pain points there, you can see that across the board, but marginally lower in queue with what we've had in the US as well. The Nikkei is down about 220, Nikkei 225 is down about 10 odd points. You got the Shanghai and the Hang Seng also smidge lower in the red this time around. Remember, you've been seeing a lot of pressure building up in emerging markets, especially what's been happening in the currency market across. There's no particular breakthrough in terms of the US and China trade talks. So all that is weighing down on sentiment, and money seems to be moving out of these markets currently. For SGX Nifty, you've got a marginal 2-point bump up. 11,632 is where we are currently trading at. So for the market setup after yesterday's a breakdown in the second half of trading session, you're going to be watching out closely for what happens and cues that you can pick up from the currency market as well, because we had record lows for the rupee. Whether or not all these factors actually start to weigh down on the mindset of foreign investors and whether they are a little bit more risk averse now to come into to India.
Yeah, so largely an EM specific problem, but I think yesterday or day before yesterday, 2 or 3 things have come to a boil, right? One is, of course, what's happening to crude and the pressure that it puts. So that, of course, keeps investors and traders on the currency as well at tenterhooks. But I think a couple of points. One is this whole conversation about India and the US and increased sanctions, and we'll talk about that. But yesterday we posted a story on Bloomberg Quint. It's not new news. The ruling came out, I think, on April 29th or thereabouts. But now there is increased focus on what this could do to investors who have largely a foreign residential title around them, because there seems to be a blanket ban of sorts. Now, SEBI, remember, on the April 10th circular, barred non-resident Indian persons of Indian origin and overseas citizens of India from being beneficial owners or in control of FPIs. Now, there would be significant number of people who would be having this. I think the story on BloombergQuint.com seems to suggest one of such parties saying that if these rules are not amended, then there could be potential outflows for a tune of $75 billion.
Yeah, that's a lot compared to $450 billion, which has already come in. So if $75 billion goes out, that could have a huge bearing on the market sentiment.
Yeah, so we don't know about the timing, really. Yeah. I mean, and whether or not this happens, are there some tweaks that come in? But the article seems to suggest, and conversations with a number of people, including Nishit Desai, the law firm, seem to suggest that this is a clear and present danger right now and could have a bearing on outflows. And naturally, if that were to happen, you would probably see some further pressure on the rupee. I'm not saying that was the reason yesterday, because this is not a new circular, but a recent circular. But maybe some of it is
I think
happening.
as we approach December, because the deadline, I think, is 31st December, where these KYC norms come into action according to the April 10th circular. So, and if nothing changes from here on and it's as per the circular, then 31st December, post that, liquidation will start. And you will see that bearing down heavy on the stock markets as well, because we have big investments within individual stocks as well. Big holdings in the likes of an HDFC bank also, which sees
a bunch of them.
Yeah, a bunch of them.
Yeah,
so,
that's true.
Yeah.
Well, so and that then there's other pressure on the markets too. But since we are talking about the currency, we've got a special guest with us. Let's find out what's the view on the rupee that Jayesh Mehta has. Fresh low of 71.21 against the US dollar. Jayesh Mehta Johnson with his thoughts. Jayesh, good morning. Thanks so much for joining in. What's your sense? I mean, almost a lot of people rather that we've spoken to in the recent past seem to suggest that this is par for the course. A bit of a gradual downtick that's happening across the EM basket and coming into India as well. What is your sense?
No, I was just overhearing your last conversation on the SEBI's April 10 guideline, right? And I would say that's what would be the most trigger. So, okay, let's look at it this way, that 68.50 where it stabilized a little bit, right? And then it was global situation. Actually, 65 to 68 also happened because of global emerging market, dollar strengthening. There was a sell-off in EM starting late April. So that's where we reached 69, and then we stabilized at 68.5, 69. And then the Turkey happened, and the story of current account deficit countries started. And that's when we got impacted. And it was more or less stabilizing, and then we had last week of August, a local factor, which is oil, and which was normal, but I think the defense flow, which happens every year around August time or so. So that was what was keeping, rupee weak. And we thought yesterday it more or less opened very nicely, stable, and it would have been stable. And in fact, in next 2-3 days, we would have expected, to mildly appreciate nominally. But I think in the afternoon, when the April 10 circular, which people were expecting would get dampened or, would get mild or something. But then when that was highlighted or re-highlighted, I think that's when the anxiety happened, and you had such a wide swing, like your equity moved from positive to negative 300, 400 points. And that definitely has an impact on currency, because year to date, we do have equity flows and debt flows negative. Current account deficit of ours was always because we had FDI, FPI flows, that's what was funding our current account deficit. And now if we thought that if again for next 3 months, if the flows are going to be negative, then definitely it will have bearing on the rupee. So that's where it is. Hope, we don't have something similar like yesterday. But if it is the same thing, if equity sells off by 300, 400 points today, we will have some impact on currency today too.
All right. Jayesh, good morning. Devina here. Just want your opinion in terms of, whether or not the RBI so far has been coming in partially to curb just the volatility in the currency, but probably not bring the currency to any particular level. Do you see them sort of increasing that intervention a little bit more in case of a further down dip? And secondly, what's been happening in the bond market with yields touching about 8% We've been seeing that being the highest in quite some time now. What do you think could be the pressure for the yields going forward? And do you anticipate this to be a mismatch within demand and supply, which is also causing this pressure in the bond yields?
So right now, 2-3 things, right? So right now, a lot of it is more weaker sentiment driven, and when your weaker sentiments sees negatives in terms of market also, and in terms of mark to market of people, it gets a little bit aggravated. So let's look at it from RBI's intervention point of view. I think they've been doing pretty fine. Again, I'm not sure. Of course, they are not keeping any target. It's just they're just targeting volatility, and more importantly, when there are huge portfolio sell-off, right? They normally tend to be away from it. So let the portfolio sell, and then they will intervene. That's the past trend. So that's the way it has happened. And in terms of bond, I think it more or less, again, I think we were almost on a recovery. We more or less stable, and that's when, FPI sold $9 billion from April to July, August, and then that's the time we were more or less getting stabilized, and, particularly local, I would say not local, but basically foreign bank FPIs actually built it up, and they were buying. Some FPIs came in again. And I think that's when, again, when the currency depreciates. I think bond is just a play of currency, right? So again, when the currency depreciates. So in last 10 days, we have been actually seeing FPI selling again, right? So but this is not incremental sell for year to date. It is what people bought in July, August, or so July last week, first week, August. So that is what is being sold off. So yes, there was a demand-supply mismatch. Nationalized banks were not buying and all that, but they have been net buyers now. But of course, not very aggressive buyers.
Got that. Jayesh, thanks very much for joining in. Really appreciate your early morning thoughts on the two important aspects that we need to keep a track of. That's the currency and what's been happening to the 10-year bond deals. The other part, Neeraj, obviously, is this week the focus is going to be on the US-India 2+2 ministerial dialogue to come to a new defense cooperation agreement that they have. But the overhang to that obviously is, the sanctions that threaten to be imposed on India if they actually don't go ahead and reduce their oil imports significantly from Iran, and they don't cancel their $6 billion deal with Russia for the S-400 anti-aircraft missiles. So, I mean, that's going to be something that probably is important from a foreign investor point of view as well, because economic sanctions on India, we're talking about a GDP growth of 8.2%. If you have a possibility of economic sanctions and a threat and an overhang of economic sanctions, because US has said they're not going to have any special waivers, if the countries are hard to be penalized for their arms agreement with Russia, they're not going to have any special waivers. So that could be a significant thing to watch out for from a sentiment perspective, and from how foreigners probably look into this.
Yeah, let's wait and watch what the implications of this, if at all. Mayuresh Joshi, fund manager at Angel Broking, joins in to talk about all of this and more. Mayuresh, a bit of pressure on the markets yesterday. Do you expect this to continue today?
Morning, Neeraj. I think a large element in terms of what's happening, I think the FPI news which came out yesterday, what's happening with crude, the rupee depreciating against the dollar, causing concerns in terms of how our trade deficit will pan out. I think these are genuine macro concerns which are probably getting displayed in terms of the nervousness that the markets have probably displayed at this point of time. Add to that, I think the global uncertainty in relation to what happens with trade tariffs. I think that again is a big overhang for the markets as well. So I think the markets have been climbing the wall of worry, Neeraj, over the last 2 to 3 quarters. Earnings have been pretty reasonable, but again, I think it was on a low base. So I think the earnings momentum, if it sustains, can lend a huge support to the market rally that we've probably seen. But my own sense is that I think the nervousness on the street might just play out on the markets from an immediate short-term perspective. But again, I think any qualitative decline onto the market becomes a good opportunity for buying into good quality stocks. However, I think the entry points have to be staggered as all these concerns are going to take time to taper off. So I think a little bit cautious on the markets at this juncture, Neeraj. But any decline onto the market, I think, will become an opportunity for buying qualitatively and selectively in the market.
Okay, stay on, Mayuresh, so much more to talk about. Let's talk about all the key stocks in news and the pockets of strength and weakness that you need to keep an eye out for. Early morning trade today. The research team is here in full strength to talk about all of those. Shraddha, Agam, as well as Saloni joining to talk about that. Good morning, all three of you. Shraddha, let's start with you first.
So, Neeraj, Jet Airways, where ICRA has downgraded the long-term rating from BB plus to BB, and even the short-term rating has been revised to A4 from A4 plus. This is the second time in less than 4 months where the rating agency has downgraded the credit rating on Jet Airways, and not just the credit rating, but we also also saw ATF price hikes being announced later yesterday. So not just Jet Airways, but the entire aviation pack will remain in focus. You also have Persistent Systems, US Arm, which has bought a stake in Herald Technologies for $5.2 million. That's about 37 crores, a very small, relatively smaller acquisition, but we'll be watching out for that one. VST Tillers has reported the sales data for the month of August. The total sales are down 18.6%. That's mainly on account of the tractor sales nearly halving to about 517 units. We are also going to be keeping an eye out for IDBI Bank. Remember, the LIC board meets today to decide on the IDBI Bank stake hike plan, and possibly we could hear about the modalities and the timelines for this. Watch out for that name. HICL Limited is another one. Ashish Kacholia has bought 1.62% stake in the company. The stock already ran up about 14-15% yesterday, but this name could possibly take it a little further higher today. And finally, in insider trades, Kirloskar Brothers, the promoters had acquired about 0.4% stake between August 30 to 31st. Not a very liquid stock, but could possibly react.
Yeah, I was up about 14% in trade yesterday, so let's wait and watch what happens. Shraddha, thanks for putting that into perspective. A couple of analysts meets, and Agam, let's start with Mindtree.
Right, so Neeraj, this was more about how the company is evolving, keeping client expectations in mind, and so the management has spoken a lot about its focus and the change in focus through the course of the next couple of years. So the management has emphasized on the focus on platform-led delivery model. They will employ the platform to visualize end-to-end IT lifecycle management, and the internal organization is also being restructured so as to have a one-point contact when it comes to its customers. This is of course going to aid and simplify matters between the company as well as its clients. The company is also focusing on large deals. This of course will mean a larger uptick when it comes to growth, and of course this also augurs well for the margins. Do remember, the company is a non-incumbent in the BPO business, or a near non-incumbent, but the company is now going to focus on the BPO business as well. Investments in digital will continue, positioning for changing trends, and of course they also see margin benefits coming in from their platform-led approach. So these are just some of the key takeaways, and it's mostly an update about how the company is going to progress moving into the next couple of years.
Yep, interesting. And what about Crompton Greaves Consumer?
So management spoke about their new product launches, their new strategy to implement go-to-markets. So company aims to implement their go-to-market strategy across the nation in next 18 to 24 months. Management remains optimistic on this strategy in the long run, as they believe that this will enhance their visibility to introduce new products, and this may increase their market share considerably given higher retail penetration. Now, in terms of product launches, management reiterated its target to launch one major product in each segment every year, and on the back of this target, company has refreshed its entire water heater range and have made some new innovations. They expect launch of new water heater product in the current season. And lastly, management seemed a little cautious on the lighting segment, largely due to falling LED prices, depreciating rupee, along with entry of new players that may weigh on their margins going ahead. So.
Okay. We'll watch out for all of these. Thanks a lot. Mayuresh, I don't know if you track HICL as a company. The stock was active, but this whole chemical stroke specialty chemical space, very, very active. What do you guys at Angel like the most?
Well, so it looks very, very interesting, Neeraj. And again, I think if you're probably talking about the Chinese perspective, I think there is ample scope in terms of how dynamics for the specialty chemical industry here will move. So I think a large element of what we have probably held on to in our funds is SRF. Yes, there have been some complications related to their packaging line and the capex related to their BOP plant in outside India. But a large element in terms of all the business segments probably coming through in the second half should hold true. The other stock that I probably like on declines would be Shri Pushkar. Again, I think a very small niche company. Market leadership in the K-asset business, completely integrated in terms of forward and backward synergies that the company probably delivers. And what it has probably done across its business segments as well, I think it's grown its revenue at a very steady clip. Again, in terms of the emission norms, I think absolutely compliant on that front. So again, I think it's going to be how the products are probably priced at this point of time. But our own sense is that because of operational synergies and because of their steady growth and the run rate that they're able to clock historically, I think they should be able to better that going forward as well. Valuations, again, not too demanding because the stock has corrected quite significantly. So again, Shri Pushkar would be something on my radar.
Right. Stay on with us, Mayuresh. It's time now to bring in our technical experts. We've got here Hadrien, Mendonca, as well as Aditya Agarwala, who's joining in right now. They're both here to take us through some stock picks and what is the call on the index. Aditya, I'm going to start off with you first. After yesterday's breach yesterday, we were talking about levels of 11,800, but now it looks like we're back to those 11,600 odd levels. What's the call now?
So if you clearly take a look at the candlestick pattern that was the formation in trade yesterday, it's called a bearish engulfing pattern, and in technical, bearish engulfing pattern is a bearish pattern as the name suggests, and it's a huge candle followed by a star doji. So the previous week when I was in the show, I just pointed out that markets are facing slight resistance close to about 11,750, 11,760. So yesterday again it made an attempt towards 11,750, 60, but it failed to cross, which led to a sharp sell-off. So right now definitely markets look little volatile and weak. On the downside, you can see levels of 11,530 to about 11,480 as well. Just a minor support at 11,560. If that is broken, a significant downside to 11,430 is also possible.
Okay. Hadrien, what about your index call?
Yeah, so I'd definitely be a little cautious. There are two important developments that we have observed. So first is, the bearish engulfing that the gentleman on the other side has rightly pointed out. But we have also observed, a short-term trend reversal post that bearish engulfing. So we have not seen such kind of a breach of important support levels since the June lows. So I think this is the first time that we are seeing, any kind of meaningful breach of important support, and support at this point of time was the 11,640 levels. So for me to turn bullish from here on will be only after we see the Nifty once again, recouping above the 11,640 levels. That is where I'll go bullish. Till then, I'll continue to remain cautious. Although having said this, the overall trend on the weekly basis has yet not changed. So the higher top, higher bottom, formation that the Nifty is very well into continues to remain intact. But it is something important that I would want to point out here on the weekly charts. Also, we are seeing a bearish engulfing pattern, on the verge of being completed. Although we have, full 4 trading sessions left before this week is over. But we really don't want to see Nifty closing below the 10,590 level, 11,590 levels. So that's very important. If that happens, I think we are going to see a bearish engulfing pattern formation on the weekly charts. And just to give you, a reminder, previously when we saw a bearish engulfing on the weekly charts, it was post the budget week, and you know what happened after that bearish engulfing. So I think very important to keep an eye on the 11,590 closing on the weekly charts.
Okay. 11,590 on the weekly closing charts, according to Hadrien. Let's talk about some stocks then, Hadrien. Let's run through your picks.
Yeah, so I'm going with Dr. Reddy's as a buy for today's session. So I'm expecting a target of 2645 and placing a stop loss at 2567. It is a pure momentum play. The pharma stocks are doing pretty well for themselves. Although we've seen a little bit of profit booking yesterday, but I think Dr. Reddy will continue to extend this momentum that we are witnessing. So one can consider buying Dr. Reddy's. The second stock that we have chosen is Dabur, and we are slightly bearish on it. The main reason here is we are seeing a consolidation breakdown after 5 days of sideways move. I think the breakdown that we are witnessing has the legs to move lower from here on as well. So one can short sell double September futures for a target of 460 and place a stop loss at 475.
Okay, Aditya, what about your stock ideas?
So one buy and one sell. I got a sell on Mahindra. It's broken down from a rising wedge pattern. Targets out here would be 926 and 900. We'll keep a stop at 960. The buy is again in the two-wheeler space. It's Eicher Motors. It's shown smart move in trade yesterday. Volumes were healthy and it's on the verge of a breakout from an inverted head and shoulders. Targets out here would be 29,500 and 30,300. We'll keep a stop at 28,500.
Okay, on to our special segment, Bloomberg Edge, wherein Jayesh Khilnani tells us about a pattern that the Bloomberg terminal is throwing up on a stock. Jayesh, what's the stock on your radar today?
Morning, Neeraj. It's Ambuja Cement. That is because the stock has, in fact, risen and now facing resistance at its 200-day moving average or very close to it. And with yesterday's close, the moving average convergence divergence has also given you a sell signal. So first, let's have a look at the MACD indicator and how it actually works. What's the theory behind it? It's a momentum indicator which shows you the relationship between two moving averages of 12-day and 26-day. By that, it calculates, plots two lines, which is the MACD line and the signal line, which in turn help you to identify where the turning points are in a particular trend. Now, as far as the buy and the sell conditions are concerned, you buy when the MACD line crosses above the signal line and you sell when the MACD line crosses below the signal line. And this is exactly what has happened on the chart of Ambuja Cement. That's the last, or rather 2018 chart of Ambuja Cement. We can see that the stock was in a declining trend, and post the month of June and July, there was some bit of uptick from about 200 to 240 levels. But the bottom panel will show you the MACD indicator. If we zoom into this, it shows that the blue line has in fact now crossed below the white line, which means that there is a potential sell signal on the cards for Ambuja Cement.
How well has this done in the past, Jayesh?
Neeraj, last 1 year, if you had sold all the indications, profit would have been close to 12%.
Well, interesting. Let's see what happens here. By the way, remember, Jayesh, thanks for putting this into perspective. Remember, at 9:30, we'll be talking to India Cements as well. The cement pack is under a bit of a cloud. It'll be important to get a sense from one of the largest, in fact, the largest player in the southern region about how demand and work is shaping up. But Mayuresh, this construction ban notwithstanding, the sales were anyways a bit damp for the cement space. Q1 numbers, again, save for maybe Ambuja ACC, the rest of the pack didn't quite deliver. What do you do here? If you are already holding cement stocks, would you continue holding them, or are they put to better use, the money that you have in that pocket?
I think selectively you obviously can hold on to cement stocks. Again, a large element of what has transpired in the past few days, the construction ban and the uncertainties surrounding that. And you're right, I think if you leave aside a few exceptional companies which reported good sales volume, led realization growth to the likes of Ambuja, ACC, to a certain bit Ultratech, I think the other companies did feel the pinch. At the same time, when you're probably talking about input costs actually going higher, petcoke costs have obviously risen. And when you're probably talking about crude prices and the rupee depreciation, you're obviously expected to see freight costs move higher as well for cement companies. So I think in that sense, the need and the mandated requirements to probably take price hikes are given in the second half if this trend does persist. The second quarter, obviously, because of monsoons, are going to be, again, very, very soft as far as the volume of take is concerned. But again, I think the pass-through effect in terms of all these elements playing out should play out on realizations. How does that play out on volumes? Again, I think that is a question mark that needs to be answered. But the inherent demand trends, as we've been seeing it on ground, probably remain a little bit more solid at this point of time. And with all that is spoken about in terms of government spending on housing, on infrastructure, I think it should come back in terms of utilization levels for the industry actually moving higher, creating the necessary leverage. So I think companies which probably operate more out of the north, a little bit of operations in the east, having integrated operations both in terms of captive power plants, grinding and split units at their center along with clinkers, should probably do well. So again, I think there might be some amount of stickiness in terms of price as far as cement stocks are concerned. But stocks like Ultratech can definitely be held on. Stocks like ACC can be held on. And within the mid-cap space, I think JK Lakshmi Cement, Heidelberg Cement probably are better placed in terms of the regional exposure.
All right. Just focus on the aviation pack. You had Kappa, which came up with a forecasting that a domestic airline industry will actually post higher losses of about $1.65 to $1.9 billion this fiscal. because of their incompetitive costs, their lack of profitability on international routes, and obviously the headwinds that we're seeing in terms of crude oil. You've already seen pressures building up across the board for most of those that, or all of them that have actually reported their quarterly numbers. But these projections obviously assume oil to be at about $75 to $80 per barrel. You've got Brent crude already at $78 per barrel. Mayuresh, is the pain still persistent within the aviation pack? And probably if you have these stocks in your portfolio, little too late, but do you get out of them now?
No, so Devini, I think the pain is going to continue, as you rightly pointed out. I think all three key variables that probably are working against aviation stock, crude price is higher, you're seeing the rupee depreciate against the dollar. And I think the competition intensity is not just coming off. So I think the first two elements in terms of the P&L reporting obviously hits them hard, and that has been very, very evident for all companies in terms of ATF prices moving 50-54% higher, hitting their EBITDA margins significantly. So even if one accounts for the cost per available seat kilometer ex-fuel, I think the optimization that can best done by aviation companies is not getting compensated with the revenue per available seat kilometer because of competition pressures. So all these elements probably working against the reported numbers for aviation companies. You're also entering the quarter 2, which is the weakest quarter for aviation. So I think stay away from the stocks.
Okay. Aditya, the cement, okay, we'll come to that in a bit. I think that we've got 10 seconds left to go for market pre-open, so let's just keep our eyes out for that. Yesterday's session was a particular disappointment towards the second half of trade. The setup right now doesn't look too encouraging. For the Nifty as well as the Sensex, you've got a dip at pre-open. Actually, it's fluctuating, but we'll wait for these to consolidate. 11,590 in the Nifty, the Sensex at 38,600. Let's take a look at what's been happening on the individual stocks. So prices are still slowly but steadily coming in. You've got the likes of a Reliance Infra. You've got Reliance Industry, trading lower. Reliance Infra, which is up about 0.2%. But bring on the heavyweights like Infosys. You've got HDFC Bank, the HDFC Twins in pre-open session from the index to see what they're doing. Infosys is down about 1/3%. HDFC is also down 1%. So more red this time around. Again, you are seeing pressures building up on the oil marketing basket as well. TCS is up about 1/3%, 2,060 there. BPCL is down 0.5%. Not been doing too well within this year itself. I mean, IOC, HPCL, all of them down about 0.5% apiece. So it's more red on the screen than green this morning. After yesterday, Spain probably looks like we're going to continue that. Sun Pharma, however, is up about 1%. Remember, yesterday Dr. Reddy saw a good flip on the upside. Today, some pressure at the start of the trading session in pre-open, 2,590 after yesterday's move of about 4%. And Wipro, that was a big gainer yesterday on the back of that big deal that it won. It's up about 0.5%. So IT, some of the defensive seem to be okay this morning.
Yeah, well, interesting start. Just wondering, a couple of stocks which were in news, because of deals or otherwise. HICL should come up on your screen. Big move in trade yesterday. Let's see what it is doing today. About a couple of percentage points higher, so an interesting move for HICL in the session today. Meanwhile, the currency, of course, continues to slide lower. So after yesterday's sharp pullback, some more pressure. Early morning trade for the rupee, marginal at that, but this would lead to further record lows. The bond yields, which are nudging the 8% mark in trade yesterday for the 10-year, should come up on your screen as well. And let's see what it is up to, 7.99, so flattish in the session today. What else is moving at the broader end of the spectrum? There is weakness in Britannia, and I think it just comes to the fore what's happening in the FMCG space. Yesterday was a pack of deep correction for the FMCG stocks. What's doing well? Not too much really. Page has this 2.5% uptick, don't know if it'll last. Maruti has this 1.5% uptick, don't know if it'll last. Otherwise, we don't have any quality names really moving around. Tata Motors DVR, though, interestingly, has a 4% uptick. I think 9% now all over the place. Let's give these rates a chance to settle down before we talk more about them. Meanwhile, while we wait for these rates to settle down, let's get in Samit Sarkar, who joins in with the top brokerage calls of the day. Samit.
On the big brokerage calls for the day, first we have is IDBI Capital on Moltech Packaging. Now the brokerage has initiated coverage on the stock with a buy rating and a target price of 377, which suggests a potential upside of nearly 18%. Now according to the brokerage, strong foothold in mold labeling and in-house backward operation integration is the key catalyst for future growth when it comes to the company. In the past, the company has focused on capacity addition, and this timely completion of capacity addition now augurs well for the company on the back of the growing demand. Now, growth in paints, lube and food and FMCG industry would support a healthy earnings growth going forward for the company, and on the back of this, the brokerage is expecting the company's revenue, net EBITDA and net profit to grow at a compounded annual growth rate of 21%, 27% and 31% over FY18 to FY20. Second, we have is Kotak on City Union Bank. Now the brokerage has reduced the rating on the stock to reduce from add and has also hiked the target price to around 200 rupees from 190, which suggests a potential upside of only 2%. Now the brokerage has cut the rating on the stock due to the recent rally which City Union Bank saw, and now the brokerage believes that this rally could be on the back of receding concerns on asset quality, loan growth and operating cost. However, for the bank there have been new concerns according to the brokerage, which is the rising interest cost and its inability to pass on this cost to consumers, which could result into a lower net interest income growth going forward. Lastly, the brokerage says that contraction in its return on equity and valuation expansion does not bode well for the bank.
Okay. Samit, thanks very much for that. So those are some stocks to watch out for on brokerage calls coming in. Just quick thoughts from you, Aditya. I was actually going to ask you about any cement counters if you track them, because we were talking about that earlier, and any of the pharma names.
So Pharma Pack definitely looks attractive. It's been buzzing for a few weeks now, and if I pick any pharma stock, probably I'll be bullish on the stock and the name. To go with few names, Sun Pharma definitely tops the list. Looks extremely attractive on the charts, and Aurobindo Pharma too looks extremely attractive on the chart. The third would be Cadila Healthcare. Stock has witnessed some bit of an up move post a good consolidation. So it's been underperformed Sun Pharma and Aurobindo Pharma. So probably Cadila Healthcare could lead from current levels. But
what are the price targets?
So Cadila Healthcare right now it's at 405. I would be looking at a target of 425 to about 440. But again, it needs to be watched out how these pharma stocks also play out, because Nifty, considering Nifty could correct, looking at the price reaction that the index witnessed in trade yesterday, probably pharma could also give some bit of its gain. So that is why I would be just a little cautious in going too aggressively long in any names. Cement, ACC definitely looks attractive. Apart from that, none really. Ultratech Cement had outperformed, so I would expect a little bit of correction in Ultratech Cement and Grasim. Probably ACC looks good at current levels. One can look at accumulating ACC probably for a target of 1750.
Okay, got that. Coming to you, Mayuresh, I want to talk about the IT pack. It's a defensive pack right now. Markets have turned a bit. They're seeming to have seen some pockets of interest out there. But one stock is Persistent Systems. It's in the news. It's got an acquisition on its plate, paying $5.2 million for Herald Technologies. What's your sense on this one?
No, so again, I think what you probably heard a few quarters back before the results in terms of the guidance that they gave out. And again, I think the acquisition in terms of how value accretive it will be, I think it's about time to probably have the right place for Persistent Systems. So I think within the IT pack overall, Devina, I think large caps and very selective on mid caps is something that we've always preferred. And again, I think the entire universe in terms of the tailwinds created because of the rupee depreciation probably are better placed. At the same time, I think the kind of investments that a whole host of these IT companies have done within the digital space itself, and that foray in terms of the transformational deal wins, specifically from sectors like retail, manufacturing, engineering, actually holding up. I think that's a very good and healthy sign. As BFSI recovers, and there are green shoots towards that, I think a significant portion in terms of earnings recovery is on the plate. What you probably seen in terms of wage hikes, visa costs play out on the EBITDA and EBIT margins, largely in the price. So I think expecting a good and a reasonable and a solid constant currency and dollar revenue growth for select few IT companies. So within the top tier names, I think HCL Tech is something that we'll still continue to prefer. TechM, Infi, obviously are holds. Within the mid-cap universe, NIT Technologies and Nucleus Software is something that we continue to prefer.
Well, some news bits coming in from SEBI now, and the SEBI is saying, remember this is in lieu of the conversation that we had at 8:30 in the morning, wherein the article, on the basis of course, what we're learning from people and what the AMRI outcome yesterday was, or the AMRI statements yesterday were, which is that $75 billion worth of investments will move out. SEBI is saying that it's highly irresponsible to claim that the entire money will move out. Now, quite frankly, it's debatable, and what these numbers would be, again, remains in the realms of possibilities. You would never know what the exact numbers would be, but SEBI is believing that this will not lead to any outflows, and any kind of number gazing, even to the number of $75 billion, would be highly responsible. But it's a SEBI circular. SEBI will go out and mention.
We are all up for positive reinforcement, so it's not it's not something that that we are propagating and that saying it will go out. So.
But this should be. I mean, the question mark only is that it's not about the quantum of the number. If it's not 75 and 50, and if that is the case, really, we don't know. This more talk that is coming in from parties which are impacted.
Yeah.
But if there are flows, and Jayesh Mehta was saying that there were flows, some reinforcements yesterday led to some of these flows as well. And if this were to be the case, then maybe expect some pressure on the markets, maybe expect some pressure on the currency as well. Though I must say, this morning the pre-open rates don't seem to suggest any kind of major pressure on the bourses, because such event is not a day event. If it is indeed going to lead to $75 billion worth of outflows, then it won't be ending in a day, and that too just about 1% kind of a move. So let's wait and watch.
Actually, I think AMRI has already, there have been clarifications and interventions sought by the FPI community from the SEBI to actually come in and clarify on this. So once that clarity comes in, then only we can say whether or not this kind of money outflow will happen or not.
Yeah, let's wait and watch. But for now, the markets, as the pre-open rates have settled down, likely to start off marginally higher in trade. The Sensex, in fact, showing an uptick of close to 1/3%. That's very, very interesting. Let's try and figure out all that you need to know to stay ahead in trade today. Just 5 minutes left for the markets to kick-start. So let's begin with Mindtree. The company held an analyst meet yesterday. It's reiterated the target of growing faster than industry and its aim of continued margin expansion.
Another company that held an analyst meet was Crompton Reeves Consumer. Pricing pressure in the LED market is a near-term pain point, according to the company.
Turbulent times have led to ICRA cutting Jet Airways' long-term rating to BB from BB+. The rating agency gave a negative outlook for the airline, citing significant rise in jet fuel prices and no corresponding increase in airfares.
Hotel Leela Ventures says it is evaluating various options to reduce its debt. The management said that it is in talks with 3 to 4 investors, including Brookfield.
Among bulk deals, investor Ashish Kacholia acquired 20 lakh shares of Heikel. The 1.62% stake was purchased at 166.5 rupees per share.
And lastly, some news from the M&A space. Persistent Systems US arm has acquired 100% stake in Herald Technologies for $5.2 million.
Small acquisition, but let's see what it does. The string of pearl strategies Persistent has been following. Hadrien, for coming on this mid-cap IT pack, as I look at the pre-open session, Persistent likely to start off marginally higher, Zensa likely to start off marginally higher, and maybe the rupee tailwind also augurs well for them. Would you trade any of these two names?
Yeah, I would prefer Tech Mahindra. In fact, if you see the weekly charts of Tech Mahindra, in the previous week it has shown a very good multi-year breakout, and that's a very, very encouraging sign for Tech Mahindra. So I think, it's more convincing on the charts if you compare it with the two names that we've just spoken about. So I prefer Tech Mahindra, and I think if anyone has a perspective of 6 to 8 months, definitely Tech Mahindra should be a good opportunity. Every decline should be a good opportunity to enter Tech Mahindra, and I'm expecting a good 16 to 18% upside in Tech Mahindra from here on as well.
Okay, so Tech Mahindra is Hadrien Mendonca's favorite play, and that looks like it'll start off on a good note. Wipro, remember, for all the fanfare that it had at the start of the trading day yesterday and started at about 327 or 326, cooled off to 310 again. Hadrien, a quick thought here on Wipro individually. For somebody who initiated a long call yesterday on the basis of the news, stock opened higher, ended slightly lower at 310. Would you continue with a long position?
Yes, definitely I would continue with the long position. Given the volatility that we saw yesterday, I think the stock may enter into consolidation sideways phase, but there is nothing to worry about because the trend is pretty strong for the past, 1.5 months. I think it will continue. There is still more space on the upside. So don't take the money off the table. You can continue to hold on to your positions.
Okay. Mayuresh, a stock recommendation for our viewers. Somebody wants to put in money to work.
So I think a large element of what we've discussed in the past, something from the mid-cap universe, music broadcast is still something that I believe on any decline investors can probably look at. What they probably achieved in terms of utilization of their news stations is clearly getting reflected very, very positively. They have increased their ad rates and that again has created a positive impact in terms of their top line growth. Now again, the capex for the 39 licenses are largely behind them. What you're probably looking in terms of ad growth actually persisting and improving going forward with hikes in rates as well. That augurs well in terms of the overall business model. And the third element in terms of a lot of state elections actually coming to the forefront over the next few months, I think that creates a lot of buzz, specifically in terms of both the ad rates and yields. So I think music broadcast, top line, bottom line growth, margin should be sustainable about 34%. Valuations not too steep.
Okay, got that, Mayuresh. Quick top calls from our two technical experts. Let's start off with you, Aditya.
So I'll just repeat. Eicher Motors is a buy for me for targets of 29,550, 30,300. We'll keep a stop at 28,500 out here, and a short call on Mahindra and Mahindra for a target of 926 and 900. We'll keep a stop at 960.
What about you, Hadrien?
Yeah, I'll go with another short call, and that's on Just Dial September futures. We're seeing a symmetrical triangle breakdown, and I'm expecting a target of 5 and 5 in the near term.
Okay, interesting. Gentlemen, Mayuresh as well as Aditya, thank you so much for joining in today and giving us your thoughts. Hadrien, stay on. We'll just take in one opening thought from you post-market open. But here's how the markets are likely to start off today. In the green, I might add, the Sensex will start off about, well, 1/3% higher if the pre-open rates are to be believed. The Bank Nifty would be interesting to watch out for as well. So about 1/3%, maybe 1/4% really, and slipping from those levels already. The Nifty 52 slipping from those levels. The Bank Nifty just getting ready to break into the red. Marginally in the green is how we've started off today. The mid caps and the small caps should come up on your screen as well, and marginally in the green as well. Doubt that the heat map will show anything different. Maybe even Stevens in favor for the advances and the declines. No, a lot more green than red on the screen. Ultratech Cement, the top loser, but OMC is under a bit of pressure as well, naturally, so I might add some bit of pressure there. But no big losers. Any gainers? Well, seems to be that IT is having a good start. Wipro, Techem, TCS and HCL Tech amongst the 4 stocks amongst the top 10 gainers at the start of the trading day. Now you can see the red moving up as well. So even Stevens on the start, IT holding out, Pharma. Well, yeah, Lupin is there, Dr. Reddy is there, so yeah, some bit of gains for Pharma as well. OMC is on one side, IT on one side. Clearly, the rupee movement impacting these names, at least at the start of the trading day. What about specific stocks? Just a couple of pockets I want to highlight before I hand it over to Devina. Firstly, stocks which did well in trade yesterday, and then stocks which are in news today. Monday's top losers, actually, stocks which lost out in trade yesterday. So Balkrishna was down, and for a corrects further about 1.25%. Adani Enterprises, though, marginally in the green. Rajeev Hoketan flat in trade today. So these were top losers in yesterday's session, starting off muted in trade. What about the mid-cap IT stocks which are in focus? Persistent had different news, of course. Small acquisition, nevertheless, but maybe the rupee movement aiding this 2.5%. Zenstar at new highs about 1.5%. Mindtree continues from where it left off, about a couple of percentage points higher. Devina, what are you spotting?
So some interest in the construction space. So you've got the likes of an HCC, HDIL, both of them gaining about 2% apiece. Another IT name, Hexaware, which is up 1%. KPIT Tech is up 1%. You've got the likes of Marksons Pharma, Wellspun India, JP Associates, which is up about 1% apiece. First Source is up 0.75%. You've got Lupin, which is up 0.25%. That's from the index. Other losers then, to quickly pull them up on your screens from the mid-cap arena, you've got the likes of a Reliance Naval, which is down in the session. One of the worst performers from the aviation basket, a Jet Airways at 279, which is down 2%. Remember, ICRA has also cut its long-term rating to a BB from a BB+. J&K Bank is down 1.86%. Should see what a Union Bank is doing after GTL's stressed assets have been bought at a 40% haircut by Bank of America Merrill Lynch and Edelweiss Asset Reconstruction. So that stock is down 1.2%. Suven Life is down 1%. You've got Capital First down 1% as well. Aside from that, some cuts coming into the likes of UCO Bank, Soba, IFCI.
Well, some interesting movers out there. Hadrien, just quick opening thoughts. We've slipped into the red. Would you take a short call on the Nifty?
Yeah, absolutely. I would take a short call on Nifty, and I think then if we see, the Bank Nifty is going to play a very important role over here. On the futures, September future side, if we see Bank Nifty, actually slipping or even closing below the 27,850, 840 zone, I think we are seeing a 550-point trading range that we are stuck in the past 2.5 weeks being broken. So I think if there is going to be a further fall from here on, Bank Nifty is going to, in my opinion, lead the fall if we see that 27,850 mark broken convincingly on the futures side. So I think that's a very important to watch out for, which would actually lead markets lower. So in fact, a good trade would also be on the Bank Nifty because it's much more volatile to the Nifty, and I can gain much more points, on that front.
All right, Hadrien, thanks very much for joining in. We're going to get in Rajeev Thakkar now. He's the Director and Chief Investment Officer at PPFAS Mutual Fund, who's joining us on the show right now. Rajeev, good morning to you.
Good morning.
So looks like we're witnessing a little bit of, aversion to risk right now, the kind of moves that we're seeing on the indices. Though foreign money has been coming in last 2 months, no doubt about that. But what's the mood like? Do you see this setup being a slightly more shaky?
I would think so. So anytime you see weakness in the currency, investors who come from abroad see a dip in their dollar returns. So obviously the market becomes that much less attractive for them. Again, whenever we see rising interest rates, the attractiveness of equities comes down, and higher interest rates, lesser liquidity is a global reality now, increasingly going forward. So again, valuations are not exactly cheap as we speak. So given that all these things are there, it's time to be cautious, and that's what we are seeing probably.
When you say time to be cautious, and does that mean take money off the table, or just wait for us to ride this period over? Because while the global market setup seems to be slightly more negative, we seem to be shielding ourselves pretty okay for now.
So we don't cover all these stocks in the indices, and I don't have a clear view on the index or broader market. When I say time to be cautious, is the factors that could lead to, let's say, lesser corporate earnings or vulnerabilities, as it were. So given that we are going to a tighter liquidity or higher interest rates, leveraged players would be risky at this point in time. Given that overall valuations are stretched, any stock which is looking frothy, one should be cautious in that space. Given that currency is weakening, any company which is vulnerable to, let's say, currency shocks or let's say oil shocks would be risky. So we have seen what happened in airlines, for example. Now again, so far the story has not come out where people who have gone in for ECBs or foreign convertible bonds, they would be under pressure. So one has to be looking at vulnerabilities in the companies that one owns and see if those are looking shaky, and if required, take money off the table. Otherwise, if on a bottom-up basis the prospects are looking good, then one can stay invested.
Interesting. I'll come to that point as well, Rajeev, but define frothy. Is frothy a high-quality space like consumers trading at above average valuations now consistently, or is frothy a mid-sized pocket which might be trading at slightly above average valuations but promise of growth which has not come hitherto, or is frothy the low-quality companies which are hanging on by a bare thread but at any point of time could go off? What is frothy?
Sure. So post January 2018, when we saw a big fall in the broader market, a lot of the low quality names saw corrections. So I think that risk off has probably happened. Consumer names, as you pointed out, are looking very, very exuberant and in pockets maybe closer to froth. Financials is a space where I am increasingly becoming cautious, especially the non-bank lending companies. So these companies are companies which rely on wholesale funding to a large part. They are vulnerable to liquidity squeezes as well as interest rate increases, as well as in the pursuit of volume growth. They have been pushing money out of the door at an increasing pace, and sometimes only down the road you realize that quality is a concern when it comes time to recover the money.
So interesting. Let me dwell on this for a bit. Everybody seems to believe that this time it is different for financials because there is this power of analytics which back the kind of lending that these NBFCs are doing. The lending is happening at a much lower cost because you don't need to open 100 branches for acquiring those 10,000, 1 lakh customers. It can happen via a cell phone, which has happened in a bunch of companies as well. So costs are lower. And while the cost of funds may move up, but the belief is that the RBI will not hike incrementally in such a big way that it will have a big, massive impact on these companies. You don't agree?
Sure. So I completely take the points that you have mentioned, and that is the reality of the marketplace. CIBIL scores and the likes have come in. Fintech has come about where you don't have to spend too much in customer acquisition or in the back-end processes and things like that. And that is why this time the problems have not been as severe as we saw earlier in terms of consumer lending, in terms of personal loans or credit cards and things like that. And again, my belief is that many of the small borrowers have intent to repay, which is sometimes higher than those of the corporate borrowers. So they don't have a chance of running away abroad and not repay the banker. The problem that comes about is they may have willingness to repay, but their ability to repay is on the edge. Their past score may be reasonably okay, but any small disruption, and we have seen spike in NPAs, for example. We saw demonetization, or because of demonetization, our NPAs went up. Floods in a state, because of floods, our NPAs went up. GST, or small business owners are facing recovery problems, NPAs went up. So increasingly, as you are financing consumption expenditure, and this is not really professional expenditure like buying a truck or something like that, it's buying a refrigerator or a television set, and as you are lending more and more to essentially the same pocket, and as competition is increasing, my fear is somewhere down the road we may be lowering credit standards, and the pain would come only after a time. So typically the lending book has to be seasoned before we see the real pain. So for example, a couple of people have been seeing stress in the affordable housing related lending, and again the problem is that there are financial institutions and lending institutions which have been there in the business for decades. Some of the newer players who are entering are more aggressive than the established players. Now arguably the newer players have lesser of experience and they should be the more cautious people. So when you turn the things on their head, and where you see loan growth rates of 40-50%, I think there would be something to be worried about. Again, the valuation themselves are not cheap. So even if you argue that loans will not go bad, even then probably there's froth.
You know, just to come back to your previous point, what do you consider as risks right now? Because across the board, macros seem to be improving. We've clocked in 8.2% GDP rate, though the CAD seems to be a little bit of a worry. We've got our inflation somewhat almost under control, approaching the RBI's target. Earnings have seen a boost. You've seen the quarterly earnings picking up. Consumption sector spending has improved. Manufacturing sector as a whole has seen an increment of about 13.5% in the GDP fine print. So individual trigger points are there on the positive side. But do you see a bigger risk looming large above all this?
So one can always look at it glass half full, glass half empty kind of thing. So for each of the points that you made, let's say inflation is more or less under control. You are seeing currency weakening, you are seeing oil prices spike, which results in oil prices increasing, which results in transportation costs going up, wages going up. So inflation may not be that much under control. The earnings growth that we have seen, some are arguing there's an element of base effect given that last year was a GST related thing. So each of the points we can debate either ways. And again, if someone is looking at a medium to long term, these things even out over a period of time. The one factor that I think about a lot is the overall valuation and what price you are paying for either the broader market or the individual companies that one is buying. I think from that point of view, we are not at cheap levels. So given that valuations are a bit stretched, one should be more on the cautious side.
So far in this conversation, we've not come up with anything that you find value in, that you find something that to be attractive from new money point of view.
So given that, let's say, interest rates are moving up, given that currency is weak, we are already seeing, let's say, export-driven sectors doing well. These were high-quality businesses which were under pressure or which did not participate in the rally, given that currency was rock solid for a long time. So you are seeing the IT pack, the pharma pack doing well. Again, a lot of the, especially the IT companies are cash rich, so they are not vulnerable to rising rates. If at all, treasury income will go up as rates go higher. So broadly, hunting ground would be spaces which have not participated so much in the rally, where valuations are reasonably attractive, and on the bottom-up basis, whatever makes sense from a business perspective.
Well, and if we start a conversation about the US markets with Rajeev, it will take another 15-20 minutes. Unfortunately, no time for that. But Rajeev, such a pleasure having you today, giving us your thoughts. Appreciate your time being with us today. Well, let's take a break on that note. The markets are lying slightly on the lower side. The Nifty Bank is down about 0.5%. We take a break. On the other side, we talk about the pressure points in the cement industry with N Srinivasan of India Cements.
The heart wants what it wants, and mine has led me to some amazing highs and lows as I followed its guidance from software development to investment banking and then into my own startup. I am Ahmed Aftab Naqvi, and my journey has been a roller coaster ride. When I started my company with a single laptop in a garage and 2 friends armed with just the burning desire to create something, I had no idea that we would create a whole new paradigm of marketing. Today, Gozoop is at the forefront of the industry, a thought leader in the space, and voted as one of the best places to work for in India. But we didn't get there quickly. But everything taught me and engineered our success. It's an interesting story, and I'm really looking forward to sharing it with you.
Aegon's of business never stop. Only on Bloomberg Quint.
This is the show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Back with Indian Open right here on Bloomberg Quint. More pressure on the markets, by the way. The Nifty Bank is now down 0.6% and the Nifty is about 0.25% lower. So after the 1% downtick yesterday, there's more pressure on our markets in the session today. Is there more pressure on the cement space? That's a key question as well. While India may be back to the 8% growth part, and that's definitely good news as infrastructure projects pick up pace, what's surprising is the lack of pricing power in most regions of the country. So as demand picks up, is it only a matter of time that they'll get to hike prices? And does the recent developments, the likes of the Supreme Court ban on construction in various states, also impact the demand and sentiment? Excuse me. Let's pose this question, or these questions, to the Vice Chairman and Managing Director of one of the country's largest cement manufacturers, Mr. N Srinivasan of India Cements. Mr. Srinivasan, so good having you. Thanks so much for joining in. Just to get the news flow out of the way first, this is Neeraj here, of course, good morning. Just to get the news flow out of the way, yes. Yesterday when we were speaking to Niranjan Hiranandani or some of the other developers, they mentioned that while there is a ban that the Supreme Court has levied on these 3 states and a union territory, it's a technical ban and it will go away because the waste management policies for some of these states are already in place. Now, I know you may not necessarily supply in a big way to all of these states, but would this be a dampener overall? And a big one at that, or do you believe the issue will get resolved?
I think this issue will get resolved. All the Supreme Court wants is that they should have a plan. So long as they submit it, I think I don't see this as a dampener at all. But it's the state should have. Most of the states in India have submitted a plan. I think these 3 states did not do it on time, and they have time. They've been given time to do it. So I don't think that this will have any great impact.
You do not, in a meaningful way, supply to any of these states, I reckon, Mr. Srinivasan.
We supply a little to Maharashtra.
Okay.
But you see, what have they said? They said no new permission for new constructions, etc. It only is aimed at the building sector, not the infrastructure, not the infra sector, which is pulling all the cement now. So I think in a very short while, they will give that waste management plan and things will be back to normal.
Okay.
I don't see it as a problem that will sustain.
Okay, fair call. Mr. Srinivasan, just a broad brush view on how the space is looking, not just from an immediacy 3-month perspective, and we'll talk about that as well, but from a slightly longer term perspective. I think the conversations with a lot of investors and fund managers over the last 1 month seem to suggest that the whole belief of cement capacity not coming up or coming up in a phased manner over 2 years has gotten negated because a lot of capacity is coming on stream over the next 12 months, and that might put pressure on individual players and their volumes as well as pricing by and large. What would your thoughts be on this?
See, we must understand that after 3-4 years of very slow growth in demand, this last 6 months, 9 months has seen very sharp increase in demand, and particularly demand from the infra sector and as well as private sector housing. Now, India is a large country. The fact that a few million tons more of capacity is going to come, I don't think is going to cause any great, it will not affect either the market or the prices, because there are only 7 states in which you can, you have limestone for a cement plant. And on top of that, I think the fact is today, if you want to start today, even brownfield, it will take 1 year before you can get an EC clearance. So all things going well, before you can even dig the ground. So I don't know how anyone says that this has gone we are aware of what plants are coming up on stream. Most of them are getting delayed. India has a capacity close to 400 million tons, out of which a lot of it is grinding. I mean, 30, 40 million tons or more maybe just grinding plants, where the clinker's supply is not, that assured. I mean, if clinker comes to these plants, it means it is short somewhere else. So if you take the scenario today, in the West, capacity utilization is high, the North it is high, Central is very good, East is growing well. Even the South, which had a very big gap, is narrowing. Capacity utilization has gone up. Ours has gone to 80% from 66% or 67% last year. And I think it will continue to grow. So I think, on balance, finally, there was a time in 2005 or so when the market turned, and from 2005 to 2009 or so, you had extremely good demand, free pricing. We may be on the threshold of that. Next year may be the year where you will see very strong prices also.
Wow. Mr. Srinivasan, just a small clarification. When we spoke to India Cements, I mean, I don't remember the exact timeline, but maybe 2 months ago or maybe a month and a half ago, the conversation was that capacity utilization would probably move to 70 to 75%. I heard you mention that your capacity utilization as of now has moved on to 80%, which is a very swift move up on the capacity utilization chain. What's led to this? Is it a burst of demand that has come in the areas that you cater to?
No, I don't remember the 75. I may have been a little cautious. Okay. But our first quarter, we operated at 80%. And I think that will go up. And in fact, in the analyst call following the first quarter results, I ventured to say that the January-March of this coming year, which will be the fourth quarter for this, we may be very close to full capacity. The reason for this is a lot of infrastructure demand, roads, dams being built, housing. So it's a combination of everything. And mind you, a lot of it is, I give you an example. If you take Andhra, Telangana together, we were estimating demand as 15, 16 lakh tons last year, or even 7, 8 months ago. Now it is 26 lakh tons per month. It's a very substantial jump. And this is with Amravati not being built. That is yet to start. So the pent-up infra demand is now on stream. All clearances have been obtained and work has started. And this is even without this consumption, even in Maharashtra, this is without the Nagpur-Bombay highway. So I think in all, and this is without real infra demand in the 4 southern states. So my assessment is, going forward, this demand growth will be sustainable, and that it's only a question of nitty-gritties of financing, etc., for some of the larger projects, and then you will see that next year, as I said, it is like 2005.
Wow. Okay. Mr. Srinivasan, just to get a better perspective here, and then I would want you to, of course, wear the industry veteran's hat and tell me about how do you see pan-India as well and not just South India. But just a small question here. Does the central balance sheet or the state balance sheet have the strength to go ahead and fund infrastructure projects in a big way in the run-up to the May 19 elections? The private balance sheets don't, and company after company has come and said that they are still on pause or a halt mode, maybe some green shoots, but largely on a halt mode as far as fresh capex go. Does the central balance sheet have the strength to do that? Because if the fisc deficit numbers recently released from April to July are to be believed, we are already stretched in the first 4 months of the current fiscal.
All I know is that they are just gobbling cement.
Okay.
Now, you take Telangana, they have got this Kaleshwaram dam. The orders placed on the cement companies, not for a specific quantity. They say supply whatever you can. So I don't know where they will get the money, but that's not for me to see. In a sense that in the last 6 months, this demand has sustained. And they're finding methods to find money. So I think it will going forward. And it's not just one road project. There are so many projects that are are being constructed. Private sector housing demand is there, which is picked up a lot. So it's an amalgam of all this. And it is. I was in Hyderabad recently, and I spoke to some of the other producers. The feeling is, okay, now that capacity utilization is going up all around, the question is, if that is so, why have prices not moved up? I think it's only a matter of time.
You would believe come this festive season beginning, I mean, almost there, but come this festive season beginning, prices will move up?
I made a statement in our analyst call that January onwards, definitely yes. Whether it will start earlier than that, we'll see. Possible, maybe. But definitely January, March, you will see better prices, much better prices. And going forward next year will be very good.
So, just trying to get a sense that I'm not asking you to put a number here, but is there a ballpark estimate? I mean, an X percentage rise in prices that you believe could be a safe estimate?
Difficult to say, except, cement is a volume game. Even a very small increase in price makes a big difference.
Okay.
The prices don't have to go up by 20, 30 rupees. At the volumes levels that the industry now is operating, even smaller increases will make a very big difference to the bottom line.
Okay. Just an industry veteran's perspective, Mr. Srinivasan. So one can understand that South is going through this metamorphosis and therefore the demand out there is very, very strong. When you speak to your peers in the rest of the country, do you sense a weak link somewhere, some pocket or some geography which may not quite have the kind of demand that the rest of the country or South India might have?
No, the rest of the country is better than South India. See, South was where you had the maximum capacity overhang. In other parts of the country, the utilization levels will be much higher. And I think, like I said, in some parts, the prices are quite good. And where the prices are slightly weak, they'll catch up also. And at the moment today, there is demand for clinker, which we are supplying from our Andhra plant all the way to the east. So the supply position is tightened up there. So price increases will follow.
Okay. I have one last question, sir. Something that could, if it could play a bit of a spoil sport. One, any cost pressures, either due to the currency or due to petcoke or otherwise, that could poop the party a little bit?
See, the cost pressure, see, petcoke prices have gone up. Now, a lot of us have switched to US coal also, so that, we don't have, we are not sure about the government. One day says you can use it, one day Supreme Court says no, etc. So why, US coal is as good enough. Coal is as good. The sum total of all this, for example, let us say the petcoke prices, the weakening of the rupee, all this put together, okay, maybe 100 rupees a ton, which is 5 rupees a bag, just 5 rupees a bag. So I think going forward, the cost pressure can be passed on without much difficulty.
Okay. Well, that's a really confident India Cements management. Mr. Srinivasan, so good having you. Thank you so much for taking the time out and giving us a broader perspective as to what could happen over the next 18 months in this space. Really appreciate your time.
Thank you.
Well, that's N. Srinivasan of India Cements, sounding very buoyant. I think the headline for me from this interaction is that he mentioning that all I know is that they are gobbling up cement. That says it all about the demand that India Cements is seeing, and he probably spoke for the industry at large. Okay, to the next discussion. DSP Mutual Fund reopened its small cap fund for subscription yesterday. Remember, the scheme had stopped accepting both lump sum and SIP investments in February 2017. February 2018 rather. I caught up with Kalpen Parekh and Vineet Sambre to find out what prompted the fund house to focus on the small cap space. Here's a slice of that conversation.
For us, the way we look at the companies, the businesses which we believe are going to be the wealth creators in the next 4-5 years, the opportunity set within those set of companies were limited. And the asset size was growing. So we wanted to sort of give a hint, as I mentioned, to the investors that the category is becoming expensive, opportunity size is shrinking, and hence we shut the fund, giving an indication that people need to be slightly more cautious on the category. Starting this year, while we saw corrections within the category, broadly the index is down by 15-16%. Stocks have got beaten down, some of them much more, some of them less. But broadly, the idea is that we believe that within our framework of companies which we are evaluating, looking at, some of the companies have come down to reasonable level of valuations, which makes a case for us to start looking at adding to those names. And even outside our coverage universe or our portfolio universe, there are a few names which have come down to reasonable levels. So as a starting point, we said, let us start taking the money. We are finding few opportunities to invest into at reasonable levels, not at the hyper levels. And I'm not saying that there is a wide array of opportunities available. It's also not that the valuations have become extremely cheap. It's only that they have come off from those hyper levels, and we believe that that's a good starting point to work with, and which is why the SIP mode. The other thought which we have in mind is that it is likely that this volatility may continue during the rest of this year, because we are going through a phase where macros are not in your favor, global volatility is very high, oil prices are higher, and we have election to face next year. Given all these factors, there is a reason to believe that the volatility may continue. And for us, again, we won't be ever able to time the lowest point in that sense. So we say that this is a good starting point. We'll start deploying money, and if it keeps going lower and lower, the markets, the valuations, it gives us many more opportunities to work with, and we can become aggressive in terms of, from SIP, we want to look at lump sum as well. So it's not an indication that from here onwards things are going to look extremely strong. It's just an indication that few of them are reasonable, and for us it's a good starting point. May become volatile, may give us many more opportunities, and that's how we are looking at it.
Do you guys reckon though that the business momentum, I mean, everybody talks about the earnings uptick that we are now starting to see, at least Q1 showed that there was some bit of earnings uptick. Do you guys reckon that in your conversations with the entire team that the earnings behavior of the small cap companies may change as well? Because, I mean, like it or not, there is also a large SME category that is brewing, and that category is also showing earnings. So is there merit now in investors, individual investors or otherwise, even starting to look at small caps or micro caps as a category from here on?
So, my take is every category, ultimately what makes long-term wealth is the quality of company, whether it is a part of large cap, mid cap or small cap universe. So good companies are good companies, bad companies are bad companies, independent of market cap. Having said that, the small cap universe has a finite amount of free float, because either they are undiscovered, or the good small cap companies that generally we as fund managers would like to invest will also have very high skin in the game by the promoters. The free float will also be less. So if more money starts chasing them, even though the company is great, the prices run up ahead of expectations, the impact cost is very high, and hence the calibration becomes very important, number one. Number two, the risk mitigation is very critical in the small cap category. So over long periods of time, there are few small caps which grow into mid and large caps, and there are many small caps which actually fall by the way.
Sure.
So selection is very important, and to some extent timing is important in periods like this when they go through extreme phase of valuation and demand. So 1 year back when we stopped it, the demand was unusually higher, which made the valuations very high. And very prudently our whole thought is that the investor experience should be protected at all cost.
Sure.
So that is the role that a good money manager will play. So which is what we've done. Having said that, now, like Vineet mentioned, 15, 20, 30, 40% price correction in a lot of companies is opening up opportunities, but valuations are still steep. Macro events are, on the anvil. Room for volatility is high. Nothing better than SIPs to benefit from volatility. I always tell investors that can you celebrate corrections and make money out of corrections? SIP allows you to do that.
Sure.
SIPs make current valuations redundant because you're averaging over the next 5 or 10 years. And I would still urge viewers, do not look at just the last 3 or 5 year returns, and do not invest in this if your horizons are only 2 or 3 or 5 years. Come in this type of category for a 10-15 year time horizon where meaningful wealth creation can happen, and you will play through all market cycles, economic cycles and business cycles.
Yeah, well taken. The question mark though, Vineet, always would be that is the risk reward in your favor right now, and where is it that you as a fund manager or head of equities seeing opportunities within the mid cap, small cap category? I mean, are these completely bottom up stories, or do you believe there are spaces within that category which are throwing up opportunities wherein you might be keen to make a fresh investment in?
I would say they are more bottom-up stories rather than any sector-specific. But broadly, if you were to ask me, there are few segments of the economies which have been doing well, and we have reasons to believe that they may continue to do well over a period of time. So, you know, within the broader consumer B2C as a category, it's doing well. The rural side of the business is doing well. Some categories are slow currently, and hence, you know, we've seen correction. The whole you know, businesses which are related directly, indirectly to the real estate market, which is currently going through a slow phase. I think there's an opportunity, because it's not that this phase is going to continue. Definitely the genuine demand is going to pick up, and we have stocks which have not been performing in those categories. So I think likewise there are a few segments which have not been performing in the past, you know, for there's, you know, being cyclically at the low level, and now in the cycle we are finding that, you know, things are looking slightly better from where they were. So I think those and then we, as I said, it's more a bottom up stock picking exercise, so it's really more bottom up that we are finding opportunities.
You would believe that this behavior of the recent past, and maybe not just, I mean, we are no one to talk about at least I'm no one to talk about the US markets, but we're seeing that in the US markets, we are definitely seeing it in India. This concentrated group of either 15 stocks on the Nifty or circa 50-75 stocks on a wider basket on BSE 500 is the one which is performing, the rest is not. Do you believe it's a turn of the rest, select pockets within the rest which will now start performing?
I think there's still some time. The broader market move will, you know, take a lot of confidence building exercise in terms of the whole where and how the economy is shaping up. And I think to me that is the key determinant of that will be the election next year. I think beyond that is where the corporates are going to take their directional view in terms of, you know, how much capex to be done, what growth to be looked at, and the broad basing of growth is likely to take place beyond that. So definitely it will happen. This concentration is matter of this last 1 year. It is not going to last. We will see broader economic recovery, broader you know, corporate growth. We are a growth economy, so we can't have only few sectors doing well, others not. So I think it will happen, but it will take some more time.
Okay, before I come to Kalpen on this macro risk, just one quick question as a follow-up on that, Vineet, and which would be that what will happen? Will the valuation convergence happen wherein these mid caps and the small caps, the valuation moves higher for the well-performing stocks, or do you believe at some point of time, I mean, I'm not getting into specific names out here, but the HULs of the world which are trading at 55, 60, or, you know, the Bajaj Finances, etc., 10 times book, pricing in growth for the next multiple years, will that pocket see a bit of a pullback on the multiples, if not pure price correction in a big way?
So my sense is till the time we have this polarization in terms of the earnings behavior itself, the heightened valuations may persist, which is where, you know, these type of companies, the HULs of the world, the NBFCs which you named, you know, till the time their earnings, they keep reporting stronger numbers versus the other category, I think the valuations will continue. But let me remind you that, you know, I've been saying this, that if you invest into these good companies which have a good predictable future for the long term, at higher valuations, the wait period has to be longer. Right. And that's a simple trick for the investors to follow.
Interesting. Kalpen, how big a headwind could this one particular thing be? I mean, we can't really predict what will happen to crude. Of course, we can't predict elections, but the sentiment around elections, how big a factor could that be also from this particular pocket of investing? Because we know that large companies, good companies will probably fall the last and gain the first. That typically happens in such periods as well. So how difficult would it be for the broader end of the spectrum to deal with the uncertainty surrounding two large election events, right? One come November and one come May.
So actually, if you look at last 4 years after the last election, what really took off in the next 4 years was small and mid caps. Since 2013-14, if you plot Nifty versus the mid cap and the small cap, these guys have actually opened up a huge gap, and a lot more flow has been chasing that segment. So I think some amount of convergence is bound to happen, and we've seen this year the convergence happening, and large caps are now catching up, because the principle of reversion to mean is supreme. You know, eventually these things mean revert, and fundamentals act as gravity. So you know, stocks generally can't last for 50, 60, 70 multiples at 12-15% earnings growth. Some point in time they will normalize. I wouldn't know how to predict when will that normalization happen, but this year we are seeing some signs of that. And in that context, independent of election, you know, while we have been talking about election, actually we are hitting all-time highs. So everyone has been talking about caution and you know, signs of worry, because it's a macro environment which is deteriorating, global trade wars, election year, yet the markets are moving up. So the market is you know, talking one language, or rather the community investors are thinking about something, but the market is completely moving in an opposite direction. And someone interestingly in our team mentioned the other day that maybe flows is becoming the new fundamental. That, you know, end of the day, in the short term, flows determine demand supply, and demand supply determines prices. So right now there is very heavy demand for you know, companies in equities across the world, including in India. So if you plot our returns, it's not just the India return, right? World over, all markets are hitting a high. So some point in time the normalization will happen, and you know, we as investors should be aware of that and prepare ourselves.
Okay. Great. Gentlemen, thanks. Just wanted to understand the logic as to why one of the predominant firms decided to reopen such a crucial product. I'm sure a lot of investors are looking forward to that.